Appreciate you guys lending me your attention tonight. I promise to give you a positive ROI on that. Thanks for your investment in the ticket as well. I think we raised some money. There's going to be a few grand that'll go towards hampers for families in need. So that's really cool too. So round of applause for you guys for doing that. You did some good. Beautiful. All right, so just a little bit of housekeeping. If you don't mind, just get you to silence your phones. Once I get on a bit of a roll, a little ring will just take me right out of my mode. So if you don't mind, that would be awesome. Much appreciated. And if you're social media minded, feel free to take screenshots of the screen. Feel free to post it on your socials. The hashtag will be recession proof if you're interested. And you can follow me on just about whatever at AJ Hazzi. Now I look out, lots of familiar faces here. I need to be louder. Thank you. Sorry, guys. I'll try to be louder. Lots of familiar faces and some folks that obviously I don't know yet, and looking forward to meeting you. I'll pretend as though you have no idea who I am, even though this looks like you're driving by the west side on a billboard. I'm sure you guys will have some idea, but I'm going to just go based on the idea you have no idea who I am. So I'm the founder of the Vantage group of companies. We have a very productive sales division, and we also have property management, manage about 1,000 doors. We have a project sales and marketing division as well, and we've got development, construction arm to add to that. And then I also manage some capital on behalf of some folks. We have a limited partnership, and I've been doing this for about 20 years. It's really all I've ever done, and I love it. I eat, breathe, and sleep real estate, and I carry 4 different licenses. I'm a managing broker, real estate agent, property manager, and what's the other license? Oh yeah, builder. Yeah. And I'm a certified real estate investment advisor. I geek out on this stuff. I love real estate investment. So I'm excited to just share with you a few of the strategies that are working well in this very changed market. And just in case you need a little more social proof that I know what I'm talking about, I am connected to Scott McGilvery, Barbara Corcoran. I write and I'm a columnist for Canadian Real Estate Wealth magazine and have been featured on Bloomberg TV. So yeah, like I say, I love this stuff. I love creating content and bringing it to you guys. Who in here has seen the market updates that I do? Yeah? Okay, so some of you have seen them. Right on. This will be kind of a miniature version of that, but if you're interested ongoing, if you do geek out on the stats like me and you like to know what time it is, just subscribe to us on our YouTube channel. We put out one of these roughly every month or 2, depending on where I am. And then last couple of years, we haven't done this, but I'm really excited to start doing this again. Has anybody been on our Ugly House tour before? No? Oh yeah, we got an Ugly House tour. OG. Love it. So this is where we jump on a bus, and I kind of curate 4 or 5 homes that I think have fix-for-profit potential. And then we jump on the bus, we have clipboards, and then we kind of just on the fly, I narrate it, and we try to figure out how we can extract some margin out of these properties and figure out what exactly we would do to them and what it would cost and what the net might be. It's kind of a fun exercise, and looking at doing that here in April again. So if you're interested, come check us out for the Ugly House Tour. I'll send out an invite to everybody if you want to do that. That'll be really cool. Now, you're probably wondering, am I in the right place? What did I sign up for here? So this is really for anybody depending on where you're coming into the conversation. If you want to do it yourself, if you're the type of person, you've got your own agent or you represent yourself, fly at it. That's totally cool. You'll pick up lots of things that you can apply to your own portfolio. If you're a done with you kind of person where you want to have us assign an agent to you, we've got a handful of agents in the room that are more than happy to help you. Hand up if you're a real estate agent. There you go. Now you know where the agents are if you need any done with you help. And then we also have a done for you option. If you just want to park your cash, this is the armchair investor. And if you want to park your cash and essentially hitch your wagon to somebody who does this for a living, you can do that as well. We have joint venture opportunities as well. So no matter where you're coming into the conversation, you're in the right spot. Okay, what do I got for you tonight? We're going to talk about our new reality. I'm going to share with you, what's happening in the market today. Then we're going to talk about the attitude required to win in this market. It's a bit of a mental shift. You got to see it as an opportunity. Then we'll dive into the tactics that actually work better in a down market. And then I'm going to go even deeper into some creative strategies that only work in a down market, which is pretty cool. If you're coming into this with limited cash or financing ability, some of these creative strategies are a great way to get your hands on some property, despite being limited in some of the financing. And then just a handful of market opportunities as well, and some examples of stuff that we're doing in real time. Is this a fair statement? Times have changed? Yeah. This was I've been doing this for 20 plus years, and this was the quickest snap I've seen. It was like on a dime. People were announcing that they were expanding, and then all of a sudden, 3 months later, they're laying people off. Like it was like that. So we got to recognize that. We got to acknowledge the change. What changed isn't the interest rates. Although the interest rates did drive it, what actually changed was the sentiment. It flipped from one of greed to one of fear, okay? At one point, the sellers were greedy, and the buyers just wanted to get in because they wanted to capture some of those gains as well. Everybody had FOMO. It was a greed-based market. Now it's fear. Sellers are scared if they don't get off the bus quick, they're going to lose even more money. Buyers are scared to jump in because they think it's going to go down continuously, and this is a self-perpetuating issue. So right now, fear is like max, which is creating opportunity. Who in here did the uncommon thing and actually sold at the peak? Did anybody just, nice, you got out of some real estate at the peak? Well done. Very few people do that, so congrats to you. Many people do the opposite, and they sell when everybody's scared and they buy when everybody's greedy. So who in here wants to buy while everybody's scared? All right, just about everybody. You're in the right room. I'm in the right room, okay, thank God. Okay, so the key indicator that I'm watching is the absorption rate, okay? And this is the amount of months of inventory. So you take all of the available inventory and you divide the amount of sales happening each month into that inventory, okay? So right now there's 300 sales a month happening and we have roughly 2,500 listings. So we've got about 9 months worth of inventory, okay? To give you some context, if you're 3 months of inventory or less, you're in a real seller's market. Now, for the last couple of years, while we went through the whole pandemic, post-pandemic boom, we were sitting at 2 months of inventory, which is why you had multiple offers and all the craziness that was happening. Then as things started to normalize, we came into what's called a balanced market. That's in that 3 to 6 months, but it never stays there very long, unfortunately. The pendulum swings all the way through until anything north of 6 months, you are now, in fact, in a buyer's market where you see downward pressure on pricing, and we've been seeing that now for 6 months. I like to track all the market drivers and figure out what time it is. So if you look at the market cycle in terms of a clock, and the nice thing about market cycles is they're easy to predict because they go the same direction, just like a clock. They boom, they slump, they recover. They boom, they slump, they recover. And so if you can determine, well, if you know where you just came from, you know what comes next. So we know we just came through a boom. So really is, where are we in this slide? How close to the trough are we is the thing that we want to understand. So how do we figure that out? Don't try to internalize this whole thing, but I'm showing this to you because I want to show you that we track it, okay? So right here, you can see that most of the highlighting happens here. We're tracking everything from population, employment, construction. We're tracking GDP, rents, all of the different market drivers. Days on market, the amount of listings, the amount of sales, all of these things correspond to a segment of the market. There's only a boom, a slump, and a recovery, and a beginning, middle, and end to each, right? Or a first, second, and third trimester. So we are in the second trimester. You can see that 10 right there. We're right in the middle of the slump, right in the eye of the storm. That's where we are right now. But when you know where you are, then you know where you're going. So pretty quickly, we're going to get to the end of this, and we're going to enter into the recovery. And after the recovery is another boom, and that's exciting, right? That's what gives you comfort. It's not going to slide backwards. It doesn't reverb. It is one continuous cycle. As I mentioned before, what is influencing us the most right now is interest rates, okay? This last little spike of interest rates is the fastest they've ever inclined in history. We haven't seen that, okay? Now, this is a zoomed out graph, like almost 80 years of interest rates. And who in this room was part of this little segment here, the 20 plus, right? I hear that all the time from folks. That must have been painful, by the way. They always say, well, in the 80s we did this, right? And I was like, yes, but houses were 100 grand, right? Now they're over $1 million. And in the 80s, they went from 9 or 10% to 18 or 20. Now they've gone from 2 to 6. So they've threefolded, and it's against a value that is much higher. And people were already borrowed to the max. And so when you 3x their interest costs, it makes a difference. So yeah, the number was staggeringly high in the 80s, but the impact is just the same. Now the other thing to note here, you can see, okay, you had this recession, right? Where things got absolutely bananas, and then how do they get out of the recession? They dropped the interest rates. Similarly, we had the dot-com crash. Interest rates were 7%. What did they do to try to get out of the recession? They dropped the interest rates. Housing crashed back in 2008. Things got really nasty. What did they do? quantitative easing, drop the interest rates. So now we're back up to 6. If you had to guess, what do you think happens next? Right. So we have a window, right? And it's that same, for the same reason why no one's going to get in is the same reason why you should, because you know what comes next. You know they drop the interest rates. You know following every slump is a recovery and then a boom. All right. CMHC says that we're going to have a sharp housing correction. Well, thanks for that. I think we've already had it. And maybe will it get a little bit worse? Sure, it's possible. The single-family home market's been the most affected. This is a graph for the single-family home market, okay? The average single-family home was close to 1.2 million, 1.198 at its peak, and has now dropped to the mid-9s. That's an 18% drop. That's a pretty big drop in a 6-month period of time. Prices have been falling about 3% a month in the single-family home market. So that's an aggressive drop. Zooming out, you look at this and you say, okay, we saw the climb that we had back leading up to the last correction, right? Pretty steep, nowhere near as steep as what we just went through, okay? You saw the same drop. That was 20% peak to trough, by the way. That was right here is right when I opened my brokerage, right here. So perfect timing. Anyways, this took about 11 months to play out. From peak to trough, 11 months, 20%. Okay, we're already at 18, it's been 6 months. And if you were to apply this yellow box, I just did this over here, that's 11 months as well. What that leads me to believe is we got a little more pain to go through, where that same trajectory will take us down into that yellow line. So I think we're going to see another 10% drop. That's just my guess. No one has a crystal ball. Anybody that tells you what things are going to happen in prices with any certainty is full of shit, but that's my best guess, okay? Also notable, from peak to when things recovered back to the same pricing, last time around took 8 years. A lot of people forget that. So what leads to this, right? It's pretty predictable. There's market drivers that you can see. So gross domestic product growth, shrinking. They just dropped the prediction from 3.5 growth to 1.75. So they cut it in half. So yes, we're seeing a shrinking of gross domestic product. After that, growing unemployment. Our unemployment rate just went from 4.9 to 5.5. Not a massive unemployment rate yet, but it's growing. So we're seeing that happen, right? The next thing is a population decline. We're not seeing that. So that actually bodes well for Kelowna. People are still flocking here. They're not buying, they're renting, but they are coming. So the population increase is good. The decrease of rental demand, I was chatting with my property managers today. They said our one guy said in the 7 years he's been with us, this is the softest he's seen the rental market. Now the headlines will tell you that our vacancy is still 0, but that's not the case. Go on Castanet, you'll see 1,500 listings today. There's lots of vacancy, and people are having to drop their prices precipitously to try to get a tenant, especially in December. So we are definitely seeing a decreased rental demand. We are seeing increased vacancies, and then if you keep going from there, are we seeing decreased rents? Yes, we're seeing downward pressure on rents for sure. And then you've got an oversupply. We're fortunate this time around we don't have a massive oversupply. 9 months of inventory is not a scary amount. In 2008-9, when things got nasty, we had like 27 months of inventory. It was really bad. Everybody flooded the market. We're not seeing that right now, and we're also not seeing the overbuilding. So that's helpful. So here's kind of what's happening. You've got converging forces, right? You've got some things that are heating up the market. So population growth coming to Kelowna. We're the fastest growing city. That's awesome. We've got a demographic cycle happening here where baby boomers are very active in the market. They've got lots of cash. There's a transfer of wealth even from their folks. And then they're transferring that wealth down to their kids, who are the millennials. The millennials are very active in the real estate market. And now we're seeing Gen Z entering the market. So demographically, and Kelowna is getting younger by the year. So demographically, that's going for Kelowna really well. But influencing the market on the other side, and you can see the deck is stacked considerably against us. We've got the interest rates. We've got government policies coming in. We've got media sentiment, which is huge. That's that self-fulfilling prophecy. Once the media gets on, then it's game over. So we're definitely in that right now. The doom and the gloom, the clickbait, all the big headlines, that's what gets people worried. And then, of course, you've got tight lending. It is really hard to get a mortgage right now. Who's trying to get financing right now? Anybody? Hard? Yeah. All right. So, as I said, Kelowna is the fastest growing metropolitan center in Canada, so that bodes well for us. That's one of the things fighting all of these other influencers. Now, This speaks to not being oversupplied. Our housing starts have been lagging. We've seen less construction. Why is that happening? Because construction projects don't pencil out very well right now. A lot of developers are on the sidelines, sitting on land, waiting. And that's a big reason for that is labor costs are through the roof. Construction costs are through the roof. It's difficult to get a project to make sense. Therefore, lots of things are not going to get built. Some of the projects even that have been sold, I'm here to tell you, will not get built. Some of the big name projects that we've heard about, people have deposits on them, those are not coming out of the ground because they don't pencil. The glass, the concrete, all those things, that doesn't make sense. The labor, it's very hard to get trades. So for that reason, so that's negative if you put a deposit down on one of those, positive if you're worried about oversupply. I'm looking at it from the perspective of oversupply. We don't have that problem. Anything that is going to get built is already bought pretty well, and we're not going to have an oversupply issue. So that's really good. That's the big difference between now and 2008. Deloitte forecasts a short-lived recession. I don't know if I believe that, but they're pinning it obviously to inflation and labor woes. Got to agree with that. Big differences, as I mentioned, between now and 2008. Lending was really loose back in 2008. Like if you could fog a mirror in 2008, you could get a mortgage. Okay, we called them ninja mortgages, no income, no job, no assets. No problem, you're approved. 0 down, 40-year amortizations, that doesn't exist anymore. So the foreclosure crisis that we had that followed that was as a result of very poor underwriting from the lender's perspective. We don't have that now. It is really hard to get a mortgage. You gotta be real solid, gold balls credit to get a mortgage today, and has been that way for at least 5 years. So we don't have a big glut of people who weren't qualified, and they've all been stress tested for a higher interest rate, okay? So that helps. It's not to say there won't be foreclosures, but not near to the degree that we saw them in 2009. And we don't have the oversupply, and helping to underpin that is building costs are going to prevent oversupply. Now, another thing to note, I've been talking about the single-family market. Single-family market's down almost 20%, but simultaneously the townhouse and condo market, you can see, have they come down a bit? Sure, but they're not anywhere close to the drop on the single-family market. Reason being for that, people have been compressed into the lower price points, right? They would have bought single-family homes, they no longer qualify. So more competition for the less expensive stuff. Therefore, you don't have as much, the prices are more stabilized. Is my volume okay? Am I losing anywhere? We're all good? Cool. So this in itself is an opportunity for people to know that. I think 2023 is the year of the move-up buyer, okay? There's an arbitrage to be had. Now, if anybody's giving any advice to put somebody out there about whether or not it makes sense to sell and buy in this market, if they're doing this, it absolutely makes sense. Now, this would be the uncommon thing because when everybody's scared, taking on more real estate sounds like a really risky proposition. But anytime you're doing the contrarian thing, there's usually a clue there. It's usually the right thing to do. The reason why this pencils out that way, let me stand back here. So a single family home, let's just say at 1.2 at peak, that was the average. It's down 20% for easy math. That means there's been a $240,000 market adjustment. So that property today can be bought at $960,000. Now that townhome, let's say, that at peak was worth $750,000, let's say it's down 10%, which it's not. It's only down 8, but let's just for easy math say it's down 10. That's only a $75K market adjustment. They made $165,000 in the difference. When the market returns, which we know that it will, they pick up that difference. So does it make sense to be a move-up buyer right now? 100. Okay, so a big part of investing in this market is having the right attitude about it, right? Everyone's fearful, it's time to be greedy. So number one, your favorite asset class is on sale, like something to celebrate, hooray, right? I know everybody's boo-hooing right now, but things are on sale. Whether it's Bitcoin, real estate, stocks, watches, everything's on sale. This is something to be excited about because it certainly hasn't been the case for the last 3 years. Your competition, meaning the people you compete with for these things that you like, whether it be Bitcoin, real estate, or watches, they're on the sidelines now because most people have a school of fish mentality. You guys clearly don't because you came out in December to learn about real estate investing during a recession. So you guys are the contrarians. I like you. You're my people. And your options are abundant. Because of the less people, there's less people that you're competing with as well. There's more on the market. So you have more options. You have an abundance of opportunity. That's the attitude you have to carry into this market. Otherwise, you get caught up in the doom and gloom with all the ERs. So I like to say bear markets are for building, okay? It's time to build something substantial. So what are we building? Well, your real estate portfolio, for one, your resume. This is the time to gather experience. This is the time to, learn. Let's get into this and let's actually get some stuff on a resume. And then if you do it right, you're building your financial independence. You're building your freedom. And that's the whole point of it, right? Like, why else would you buy real estate, right? You're trying to create a lifestyle for yourself. You're trying to create multi-generational wealth, a legacy for your family. That's why you do it. You don't do it because you love interacting with tenants. You don't do it because you love rolling up your sleeves and pulling floors up on a Sunday. No, it's because you're trying to create something for yourself. And now's the time to do it. So it's time to invest. Number one, invest in your knowledge, right? That's the number one investment you can make, is knowing what the heck you're doing out there. Number two, invest in your network. You say your network is your net worth. Build a really good team of people around you. Get a killer mortgage broker. Get an agent that speaks this language. Get a lawyer that knows this stuff. Get an accountant that understands this. Build your team out. Build your network. That's what we're building right now. Invest in that. And then invest in distressed assets. I like these 3 books, so I'm just going to pitch them. I don't have a dog in this fight. I didn't write them. I don't get anything for this. But these 3 books changed my world. Okay, so grab a screenshot of that. If you haven't read these yet, this is like mandatory reading if you're going to get into the real estate investing game. These are like the Bible as far as I'm concerned. This one particularly, and then this one gives you the mental framework for it. And then as you want to get it more in the weeds, more granular on how to flip and hold properties long term, these are 3 badass choices. Read them over the holidays, and you've got all the knowledge you need. All right, so I like this little tweet here. My biggest financial mistake was being in 8th grade in 2009 when I should have been buying foreclosed real estate. Oh man. How many people here wish they had a little more dry powder the last time things got cheap? Yeah. How many people did take advantage of that market cycle and made a heck of a chunk of change? Nobody wants to identify themselves because they're worried we're going to come after them for money. That's good. So foreclosures were where the opportunity came from the last time around. Okay? And a lot of people right now are sitting there thinking, they're wringing their hands thinking, okay, when are the foreclosures coming? I've been hearing that for about 2 years from investors who have had cash parked. They're waiting for foreclosures. So just for fun last night, I know intuitively that there aren't many, but I wanted to see really what it was. This is the foreclosure list last night. There's 3. 3 on the whole market. You got a property on Raymer, which actually wasn't too bad. That's right on the corner of Raymer and Gordon. It's a development piece potentially. Not a bad little hole. They've dropped the price from 1.1 to 900. This little thing was kind of weird. It was a little $250,000 cabin on the water on wood. And then you've got this, which I actually like these units as well, but it's not cheap enough yet. But these units on Cook, these short-term rentals, are good. But that's your foreclosure list. I made like a living sending foreclosure lists to people back in 2009, but there was 150 properties on them. There's 3 now. So I don't know that foreclosures are our opportunity. So we have to look outside of that. Maybe they'll come, but they're not here yet. There is opportunity, though, right now. So what is that opportunity? Let's figure that out. Distressed sales, so people who are not necessarily in foreclosure yet, but people who have other reasons, right? The big Ds, drugs, divorce, all the different things, death. These are distressed sale opportunities. They are happening, okay? Most people don't sell a home right now unless they have to for some reason, right? Or it's a lateral move, or they're moving up. But for the most part, you're not selling unless something in your life is forcing that decision, okay? Which creates distressed sales. Duplex conversions are an opportunity right now. For those of you that don't know, they've just recently changed a zoning bylaw to allow half duplexes and full duplexes to have legal suites in the basement. They do this because they want to stimulate affordable housing. This creates a ton of opportunity for people to buy a half duplex for, say, $650,000, put a suite in there, and now you have a 2-apartment building for way less than what a single-family home with a suite would cost you. So there's some cash flow opportunity there. Student housing, I think student housing is an opportunity because of the recent changes in the rules. They have made it so that you can no longer mandate the mutual agreement to end tenancy. So people who do short-term rentals, they typically would put a student in there September 1 and then pre-agree that the student's got to get out in May or June. Now you can't do that. If the student wants to stay, they can say, I'm staying, beat it. So what do you think that person does? Well, they leave it on bookings.com for the whole year and they don't make it a student rental anymore because they're not willing to take that risk because they get more revenue in the 12 weeks of summer than they do for the rest of the year. So they're not going to risk that. So they're going to close and shrink that supply. And students are going to be displaced. At the same time, UBC is expanding. So there's more students pouring in all the time. So I think there's an opportunity in student housing because I think that's an underserved part of the market. I have a couple properties where we've kind of house hacked it. And we've put lock and key on each bedroom. We bought a 12-bedroom house downtown. And it's a great cash flow generator. People pay $1,000 a room. There's 2 kitchens. It's all communal. You know, we pay for the Wi-Fi and all that, but it brings in like 140 grand a year of this one house. It's pretty crazy. So there's opportunity in student housing, and I think there's opportunity in multifamily. And I'm going to dive deeper into the multifamily opportunity here in a second. It's a bit of math. As I mentioned, these new rules do create new opportunities. So the other big rule that just changed was stratas have now said that the strata corporations cannot mandate age restrictions or rental restrictions. Now, when we look as realtors for people who are trying to find condos, the market is limited for the fact that many of these places will not allow rentals. So if we're working on behalf of an investor, there's all kinds of cheap condos, and we're like, oh, that looks like a deal, and then, oh, no rentals allowed. So now that's changing, which means there are some cash flow opportunities in some of the inexpensive condos, particularly in Rutland, because that's close to the university. Those condos are like 320, 330 grand. They allow no rentals. They're 19 plus, highly restricted, meaning they're limiting the buying pool, which is keeping their prices down. Those new changes will get priced into the market soon enough. And then we have no more foreign buyers. I haven't quite figured out what the opportunity in that is yet, but that is a new rule. And there will be some corresponding opportunity, and I'll let you know when I figure it out. But right now, just be mindful of the fact that as of Jan 1, Americans or anyone else that doesn't have their landed immigrancy here cannot buy real estate. All right, these are 2 examples of condos that are 19 plus, no rentals, that I thought those are definitely underpriced. You've got a 3-bedroom, 2-bath right downtown, 1,500 square feet for $440. That Maple Keys building on Bernard, that would make a great rental, but they don't allow them. Well, they can't. They have to now. I think that's going to be worth over $5 the minute some investor gets their hands on that. McIntosh Road, that's that one in Rutland. I think it's Magnolia Gardens maybe, but another one there, a 2-bed, 2-bath for $325. Same thing, age restricted, rental restricted. The reason why that's cheap is because the buying pool is small. So these little things are opportunities, right? Nice little foray into the market. Pick up something like that before it changes. Here are the challenges you face right now as an investor in this market. Number 1, very, very hard to get financing. Very hard. If you can get financing, it's also very hard to get properties to cash flow. The reason being is the interest rates have gone up faster than the rents. Now we have downward pressure on rents and we have upward pressure on interest rates. That makes getting things to even break even a challenge. So you really have to sift and sort through a lot of opportunities before you find something that can even break even right now. Because the job market is getting more challenging, because we're going into recession, you're going to have people defaulting more. Okay, you're going to have tenants, they're going to do the midnight dash because they lost their job. People are going to fall on hard times. So your vacancy risk in times like this is much higher. So if you go into a property, go into it mindful of the fact that you might be vacant for a couple months. And our property managers are telling us that to fill a vacancy right now, you have to budget for 60 to 90 days. It's not like you put it on and it's gone in 3 weeks like it was before. So you've got to have some staying power. So don't overcommit to something where you don't even have a bit of a buffer in the account. Make sure that you've got 3 to 6 months worth of your expenses in your operating account so you don't get hurt on this, because that's definitely a risk for investors today is vacancy. And then more and more, especially with our NDP government, you're seeing tenants, like policy that is designed to protect tenants. They don't give a shit about landlords, okay? And this is making it harder and harder for us to operate, like rent control. It's really challenging. So Alberta looks pretty favorable these days in comparison to how we're being treated as landlords here. Despite the fact that landlords, if you're really worried about affordable housing, make it easy for landlords to own and operate, because the bulk of the inventory is privately owned, right? It's owned by mom and pop people like the people in this room. And you make it too hard, well, what do? We sell it. And we say, I'm out. So I think these policies, although they have good intentions, are having the opposite effect. They're actually shrinking the supply. All right, what's out of fashion? what you should avoid right now, I believe, I like short-term rentals, I really do, but I think there's some challenges in that space right now. Airbnb is having a bit of a there's like a pushback against it right now. People are kind of saying, okay, hold on guys, like you want me to do the laundry, you want me to do the dishes, like I can go to a hotel and do whatever I want. I don't have to pay a $150 cleaning fee and take out the trash, right? There's a bit of a pushback right now, and because so many Airbnb units came on the market, there's more choice. So although Airbnb has said they had their best year ever, if on a per host basis, it has not been the case. There's way more hosts and people have more choice and they're pushing back. So I would be cautious about going into short-term rentals right now, and I would not do anything speculative. If you're into building, I would stay away from mid-luxury. Mid-luxury is a dangerous, dangerous space right now because they are the most affected by interest rates. The people who are aspirational about the homes they're trying to buy, they're buying a little, or right to the very edge of their affordability. The interest rates have curbed that. So inexpensive stuff is always in fashion, but right now that executive level stuff, if you're trying to build that on spec with expectations of making a margin when prices are falling while simultaneously interest rates are going up, that is a dangerous game. So I would be cautious about that. Let's talk about down market tactics. In case of buyer's market, break glass. Number one, vendor financing. I love this. I acquired so much real estate with vendor financing back in 2009 and 10. And of course, for the last few years, there's no chance of getting anybody to entertain the idea of a vendor take-back mortgage. Like, they would just laugh you out of the room. But now, you can get this done. Lease options. I'll explain vendor take-back mortgages in a second. Lease options, same thing. I'll explain these as well. Nobody was going to have any time for you if you would have proposed a lease option to them 2 years ago, a year ago even. Now, people are listening, okay? These two options are great ways to acquire real estate if you're limited to capital and financeability right now. This is how you get your hands on it. And then joint ventures. We're going to talk a little bit more about that. So I'm going to unpack each of these. But these are the 3 down market tactics that only work when things are tough. And the cool part about it is you get the maximum amount of leverage, the least amount of downside risk when you're using some of these strategies. Excuse me. So hang on, I'm just going to get my water. Where did my water go? Jeff, can you grab me water? I'm dying here. No, it's perfect. It's right there. Thank you, though. Getting a little dry. Thanks, pal. Am I going too fast? We okay? Content's okay so far? All right. All right. So if you're interested in seller financing, this way? That's good? Forward? All right. Okay. So if seller financing is your jam, we're going to unpack that a little bit right now. VTB stands for vendor take back mortgage, okay? So let's get into it. What is that? Well, why does a seller want to do this? How would you sell this to a seller? Number one, they're going to maximize their purchase price. Because in a negotiation, there's 2 things. There's price and there's terms. If they're willing to offer you terms, then in exchange for that, they should get price. So they're going to have a better price than they would have if you came in as a cash buyer. So they would do this to get a slightly better price. Number 2, it's a solid investment opportunity for them. You're going to build in a rate of return for them, and they already understand the asset because they live in it. So they're likely to consider that to be a solid investment opportunity if you offer them a decent interest rate, better than they would get elsewhere, and they can invest in a home they've owned for the last 10 years. This is a very solid, safe investment for people. And they also benefit because they have improved odds of selling. Right now, 2 out of 3 homes will not sell. So they have to dangle little incentives or little carrots. So they would be willing to do this if it increased their odds of just moving on. Like, okay, what do I have to do? That's the conversation with sellers right now. What do I got to do? Well, we got to dangle some carrots. This is one of them. So that's how you would sell it. If you wanted to, and you can take a screenshot of this, I'll get out of the way. If you wanted to include this in one of your contracts, it's pretty simple, right? You're just saying that you're going to provide financing. Here's the interest rate. Here's the terms. Here's the payment. And you put a clause in your contract. Realtors don't do these kinds of things because they overthink it. They think this is really complicated. The lawyers will deal with the mortgage. The lawyers will register the mortgage. All you have to do is negotiate it and put it into a contract. You have to be able to explain it, and then you negotiate it. This is not that complicated. All right. Lease options are like, I love lease options. And again, realtors run from these because they kind of either don't understand it or they've heard some horror story. And there's tons of horror stories about lease options, and I can tell you where they come from. It's people who took like a late night infomercial course on how to do, it's called sandwich leasing, where they don't really own the property and they go and they they lease it and they option it, and then they go and advertise it as like a rent-to-own opportunity for somebody, and they take a $20,000 deposit, write some really crappy little contract, and then they disappear. And that person who got put into that deal had no hope of buying it. They got taken for their 20 grand, and that creates these horror stories. So lease options, a rent-to-own, has a terrible reputation, but it's actually one of the most effective strategies for acquiring property, particularly when the banks say no and you're limited in terms of the capital that you can provide. I acquired so much real estate in 2009 through 12 by way of lease options. Some of the stuff that I kept and even developed, and I'm talking about acquiring it with half a month's rent and an agreement that I would maybe buy their house. So what are the benefits? How do you sell this to a person who owns a piece of property? Big three are, again, same as a vendor take-back mortgage, a premium sale price. They're going to get a little more than they would get if you were a cash buyer, so that's one incentive. They're maximizing their sale price. The next is you're taking on the responsibility of the property, which means you're going to take care of all repair and maintenance. So you're taking the hassle, you're taking the liability of the home off their plate, okay? The best people for this are people who were attempting to sell. Okay, it's not selling, I'm going to make it a rental. So they're in that, right in that space where they've got their head around the idea they're going to rent their property, and then you pop in and you say, hey, I got a better option for you. I'll be your tenant, and I'll do you one better. I'll take care of all repair and maintenance. I'll never call you with a leaky toilet, and I'll even agree to give you close to or what you were asking when you were for sale there, and I'll look after this property for the next 3 years for you. Thank you. Half month's rent, option agreement. You now legally control this property. It's pretty cool. And the seller, who was going to put the property back into the rental market and then hold on for brighter days to resell it, they know they have rehab costs. They know that when they get this property back, they're going to have to paint it, probably change the floors, and so you're mitigating those rehab costs for them. So when you pitch it, hey, I'm going to give you more than anybody else is willing to give you right now. I'm going to take care of all repair and maintenance, and you're not going to have to spend any money to sell it because I'm going to buy it. Right? So that's the pitch on a seller option or a lease option. Why would you do it? Well, big three for you are no banks needed, which right now is a godsend. You have the highest possible leverage. In many cases, half month's rent. Sometimes you might have to put 10, 20, 50 grand down, but it's a heck of a lot less than you would be if you were putting 20 or 25% down with the bank. And you have a hedge against future inflation, but with no downside risk. That's a big deal. That's called asymmetric upside. You have almost no downside, just your half month's rent and maybe the risk of a vacancy, but you have unlimited upside. So when the market recovers, and if you can lease this thing and it happens to go, it's just like options trading in stocks, right? If the market goes past what your option was, you make huge money. If it doesn't, you're just out with that little option fee. Same thing in real estate. Okay, so it's a huge hedge with unlimited upside and a very, very small downside. Really simple. When you're negotiating an option, there's only 3 things to worry about. Number 1, what's the option price? What is the price that you're getting the option to purchase it at? Number 2, what is the term? How long do you have that option? Okay, I'll give you $1 million for your house. How long? Do you get 6 months? That's not going to be great in this market. You need a little more time. So try to get it for 2 or 3 years. That might be enough time for the market to recover and for you to be in a good equity position to close on this when the dust settles. Or you don't even have to close on it to realize the gain. You can sell it. Because within your option contract, you have the right to dispose of the property. So if it goes up to being worth 1.2, you put it on the market, you pay the option amount you agreed to pay to the seller, and you keep the difference. I did that many, many times over during the downturn. Very, very lucrative. And you got to negotiate your option fee. This is essentially the deposit. This is the skin in the game that they're wanting. Now, if they're not looking at renting the property, if they hadn't already got their head around the idea of handing the keys to somebody for half a month's rent, then you're going to have to come up with some real money. If there's a realtor involved, they want to get paid out of this option deposit, so there's going to have to be a little bit of money. There's going to have to be 20 grand or 30 grand option. If you're finding somebody that's in that space, though, where they're about to become a renter, a landlord, you're offering them something better than that. They've already got their head around that. You're a step up from that. They have an upward view of this deal from handing the keys to some tenant they don't know for half month's rent and hoping for the best. This is a better deal for them. All right. Hope you guys liked that little bit on vendor financing. Let's get into a strategy that requires a little bit of cash. It's the BRRRR strategy, okay? So BRRRR stands for buy, renovate, rent, refinance, and then the best part, you can repeat it. So here's the math, okay? And you can do this in a cycle. You can take the same, if you have the cash to buy a piece of property and renovate it, you can do this and recycle the same cash over and over and actually build a portfolio. You don't even have to sell the properties because you're creating value. So the step one in the process is you have to find a distressed sale. You can't pay market value. You have to buy something at a margin of safety. Okay, so if you go out and you find a good deal, you buy something 10, 15% back of what it's worth, you've completed step one. You've bought a property at a distressed price. Then your next job, most distressed property has a little low-hanging fruit, you know, some floors, some paint, some fixtures that you can do to make some, you know, some quick money on that property. Usually that low-hanging fruit gives you a 2 to 3 to 1 return, right? If you go in and do floors and paint, you're almost always going to see, like a $30,000 lipstick reno will almost always get you 80 to 100K in value. So that's what you're looking to do. You're looking to do those low-hanging fruit. So in this example, you go in there to this $1 million home that you bought for $850. You say you spend 100K. That's a pretty nice lipstick reno. Okay? Your after reno value, and we just did this on a house on Mount Royal. Your after reno value is 1.25. Okay? If you want to keep this property, you can now refinance it at its new loan to value. The banks will give you 75, even 80% of its new value. I use 75 to be conservative, which means you could finance out $937,000, which is damn near what you had in it in the first place. You only had $950 in the deal, right? So you're pulling almost all of your money back out, and you still have the asset with $300,000 of created value. Rinse and repeat, right? That's a strategy that works. But it only works if you can buy the property at a distressed price, which means it only works now because you weren't getting a deal a year ago. There's no chance. Now you can get a deal. And so this starts. That starts the cycle. You can do it in multifamily. So if you got a little bit more access to capital, or you can partner with somebody who does have access, there's huge money to be made in multifamily right now because there's a couple things that are kind of conspiring against apartment buildings. So the ROIs could be huge on this. Most people right now are focused on the fact that if they buy them and pay high interest rates, they're unlikely to cash flow, so why would they buy them? Because most people buy these things for the cash flow that they generate, and right now, they're very unlikely to give you a positive cash flow. But if you were willing to go in with that knowledge, and you understood that and were willing to deal with that, there's huge opportunity. So, let me explain to you how apartment buildings get valued. People talk in terms of cap rates. Who here knows what a cap rate is? It's kind of like a high jargon thing for investors. Okay, so cap rate is just another way of saying risk rate. It is the rate of return that investors expect out of their investment that they're willing to part with their money for. So in this example, this building brings in $150,000 in rent. You have your regular expenses. It brings in a net operating income of 100 grand. Okay, just simple math, 100K. In a world, like a normal world where investors, they want to see about a 5 cap. So that's where things get bought. Apartment buildings trade hands at a 5 cap all the time in normal markets. So that means that people are paying a derivative of, you take the net operating income and multiply by 20, which is how many times 5 goes into 100, right? Follow the math. So a 5 cap means it's 20 times that, which means it's worth $2 million. So in normal markets, investors are willing to pay $2 million for $100,000 of net free cash flow. That's just what stuff gets valued at. These buildings are not valued based on emotion. They are valued purely based on their financials, okay? So it's not about the flavor of the week. It's not about what's hot. It's about how much does this thing make and what are other investors paying. Those are the only two things that matter. Now, the market we just came from was a 4 cap environment, meaning that investors, because rates were cheap and they could make the spread on 2% or 3% money, they were willing to invest in a building that only had a 4 yield because their leverage that they had, meaning they only had 25% of their own capital, 75% of the building was paid for with 2% money. So you can afford to pay more. So investors would chase the value up. So that same building 6 months ago was worth $2.5 million. Now interest rates are north of 6 for commercial, which means this valuation would actually be even high right now. An investor would be unlikely to give somebody $1.6 million for the asset they would have paid $2.5 for 6 months ago. Now we saw the interest rate chart. You guys saw it spikes, and then they go, oh shit, we overplayed our hand here. What are we going to do? We've got to get the market going again. So what do? They drop the rates. What do you think happens to the value of multifamily when they do that? Big upside. Did you make any cash flow in that period of time? No. But you made $1 million on the building. The other cool thing is, when you get into this space, When they're valuing, when you get back to that space where you're going to sell it, next time it becomes a 4 cap, or you're going to refinance it and get all your money back, that's the BRRRR strategy, the repeat and refinance. You can buy these buildings over and over again. But what's even cooler, you can create value by decreasing expenses or raising rent. You don't even have to wait for the interest rates to change. If you can renegotiate your property management contract, save 10 grand, it's worth 20 times that. You just added $200,000 to your value. If you can increase the rents on your 12 units by $2,000 a year, you added 24,000, you just added 480 grand to the value of your building. Is this making sense? It's huge. Now, a lot of people think, well, a lot of money to risk buying a building, buying an asset for $2 million. A lot of people think, well, that's got to be really hard to finance. Actually, these are easier to finance, and they're less risky. They're less risky, and that's why the banks like to finance them more, because it's not based on your personal net worth as much as it is based on the cash flow that comes from the building. It's a commercial lending product that lends against these. So they don't care if your net worth is 300 grand and you want to buy a $2 million building. They care if the building spits out 100 grand net operating income and has done so for the last 3 to 4 years. You're essentially buying a business, okay? In addition to that, they're safer because if you buy a single family home or one of these condos for 300 grand that I shared with you, and the type of people who rent $300,000 condos, there's only one tenant, and the likelihood of that person going vacant and you having zero cash flow, that's risky. You have a 20-unit building, 4 units go vacant, and you're still cash flow positive or breaking even or just a little under, that's not so risky. And that's why the banks like them more, because they're way, way less risky than a 1 or a 2-unit building. Does that make sense? So the more you spend, the more diversified it is. That's how they look at it. The risk is spread out over more tenants. So as you spend more in multifamily, it becomes less risky. So what to look for if you're going to take the plunge on multifamily, and I hope that you do. Look for buildings with deferred maintenance. It would be natural to think you want the nicest, newest cream puff building. You don't. You want the ones that are dogs. You want the ones that have been let go a little bit, because that means the rents will be low. That means they're going to have to agree to a lower price because you can factor that deferred maintenance into the negotiation. Number 2, you want poor management, right? That's where you're going to go in there and find ways to create economies of scale, efficiencies, lower costs. That's all going to get added to your net operating income and increase your value. You want to find below market value rents, because the simple process of normalizing the building to the market rate will raise your value huge. And you want to find a property that has above market expenses, because every penny saved is just as good as a penny earned when it comes to your valuation. So you want to look for ways that you can, like I say, take the expenses down. And then I like properties, multifamily properties, that have some additional land. So maybe there's like a 12-plex on a half acre. And under the zoning, you could actually have 60 units on that. It just got built in the 70s when the guy didn't care to maximize the parcel, right? Those are the holy grail, because not only do you have the asset for the next 15 or 30 years, whatever the economic life of the building is, but you have the uptick of now you have a development parcel down the road, huge, huge value. When the economic life of the building starts to wane, the value of that land is increasing. Make sense? So if you can find something with some residual land, that's the holy grail. And look for an equity seller. And why is going right back to the vendor take-back mortgage. Get them to leave 25% in the deal. They've already owned a building that's performing at 5%, okay? They've owned this thing for a while, and they have a bit of hassle to get it. Wild guess what interest rate you might offer somebody that owned that building to carry a mortgage for you. About 5-6%. It's the same building, it's the same rate of return they've been expecting and getting for the last however long they've owned it, right? You might have to pay more, but it's a good starting point, pretty logical. And then you want to find a building that has proper historical financials, because going back to my statement before, you're not likely to be the reason why the bank says yes, it's going to be the building. So in that case, you got to provide solid financials to the bank for them to be willing to play ball. If it's, some guy that's been shaving it down and penciling it and not declaring any income and taking tenant money by cash, that's going to be harder to finance than somebody who's kept tight books. So you need to find those sellers that have been diligent about keeping good books, unless you're all cash, then it doesn't matter. And then I look for low-hanging fruit renovations. If I can go in there and raise rents by adding a washer and dryer to the unit, or a dishwasher, or a bathtub where one didn't exist, or new floors, just little cosmetic things that you can do to raise the rent, to take them from $1,000 a month to $1,200, and all you have to do is go in and spend 12, 15 grand, that's like That's what you want. And you want to do that over the course of, over time. You know, you're not going to do it all at once, but you just pick away at the units. But you want these older buildings that are a little behind on their maintenance, and you slowly work away at them. And of course, always buy in a great location, something with good walk score, or it's next to transit, close to a university. You know, don't buy in these weird outliers. And you're not limited to Kelowna. In fact, there's almost no multifamily opportunity in Kelowna. You got to look elsewhere. You got to look in, Alberta. You got to look in markets, just outside of Edmonton, just outside of Calgary. Those markets have lots of multifamily. You can go south. You can go. Penticton has more. Vernon has more, but Kelowna has almost none. And they're all owned by a small group of people, and they barely ever sell them. So you have to go outside of Kelowna for this, but there's lots of reasons why you'd go outside of BC for owning apartment buildings, not the least of which is the rent controls. No transfer tax, there's lots of good reasons. I'll skip this part. So let's say you want to do it, but you don't have the cash, or you're looking for some way to put this together. You're deficient in either the ability to finance, or you're deficient in the amount of cash. Joint ventures are the answer. Has anybody in here done a successful joint venture before? Got a handful, good. Almost everything I did through my 20s was in a joint venture capacity. We acquired and built and did tons of stuff in joint ventures. So there's kind of a formula to it. And if you're thinking about doing it, take a picture of this, but this is how it works. Whoever has the cash gets half the deal. They literally have to do almost nothing else other than provide cash, they get half the deal. Now, many people who are short on cash, but long on time and expertise can do all the others. They can go get the mortgage, particularly if it's a commercial asset. It doesn't even matter if it's them, it's the building, right? So they go arrange the mortgage, they can find the deal, source the deal with the realtors, do all the background stuff, analyze it, do all the due diligence, and then they're kind of managing it as well. You're not going to pay a property manager in this case, they're managing it, and for all of that, they'll get half the deal. Now you can carve it up in different ways too. You can have half of each of these, right? You can share it in different ways, but this is really what each of those 4 things is worth in a joint venture scenario. Okay, switching gears here for a sec. If you're more of an armchair investor and you're looking for just a done-for-you thing, I've got a pretty good little opportunity here that one of my clients is raising the last bit of capital before this very exciting Big White project gets off the ground. So this is right in the village, about as good of a property as you can find. It's got a beautiful, beautiful view, and it's going to break ground this year. This is going to be a concrete building. It's going to be mid to high end, units starting around 700,000, going up to north of $1 million. Really, really ace location. It's going to have in-house management. This is going to be one of the marquee developments up at Big White, for sure. You won't be able to read this, but the pro forma looks very, very good on it. I think they're doing $100,000 tranches, a unit in this limited partnership, and they've got an internal rate of return, I don't know if you can see it, forecasted north of 34%, which is almost unheard of. For just parking cash, doesn't get any better than that. They've got a really nice margin in the project, and yeah, as I said, they're just about done the fundraise. I think they're looking for a handful more investors at about $100K a piece, so it's a good opportunity there. Why do I like Big White? So I did some little investigating on this. Best appreciation anywhere in the Okanagan, including north and south, over a 3, 5, 10, and 15-year time horizon. And I didn't know that. That was actually news to me. I thought Big White had a period of time where it was a dog. But any which way I looked at it using the home price index, it was the best appreciation out of anywhere in the Okanagan. Simultaneously, it actually has the least downturn. Since things got a little bit messy, it's only down about 4.5%. The rest of the market's down 20%. Big White's held its ground. Also, with Big White, it's becoming a year-round investment, or a year-round destination, which means that the rental numbers are going to get better and better on it, as well as the values. You're going to get more eyeballs, more people coming up from mountain biking and Four Seasons stuff. So I think Big White is still in its infancy in terms of being on the map, and I think there's still a lot of runway for Big White, particularly as it becomes a year-round destination. And then article just came out, I think it was yesterday, showed 45% year-over-year appreciation in Big White. That's huge. No other place in Okanagan saw that. And then, of course, if you invest at Big White, you also get the personal enjoyment component, which is cool, right? You're not going to go spend the night at your duplex. So that part's cool. All right. I'm going to walk you through, you're going to see the logo now for Cash Offer. That's the limited partnership that that I run. And that's where just like, I think we've got about 40 limited partners now. They park some cash with me. And I just run my playbook, any opportunities that I see that make sense depending on what the market's doing. And I'm going to kind of show you what I think the strategy is going forward. So right before we had this meeting, we had our annual general meeting where I just explained this. I said, here's the blueprint for 2023. I'm just going to share it with you guys now. If you're a DIY person, you can just see exactly what I'm doing in the moment right now to take advantage of the market, apply it to your own. And of course, if you're interested in having a conversation with us, you know we're open for bids. So starts with letting the world know that you've got cash, that you're willing to quickly, it's like some people send out letters, we buy homes for cash. Some people put scraggly little signs on telephone posts, we buy homes for cash. We're just doing it in a digital, slightly more, sophisticated way. Sell fast, stress-free. So I'm going to fire these ads up again. I ran them heavy in 2018, got a little bit more action than I could handle. It was more cash than we had to spend, so we stopped. We pumped the brakes on these ads, but they work very, very well. The amount of people searching right now online, sell my home quick, has gone up 2,400%. That's kind of scary for just where we're at in the world, but it's an opportunity if you're in a space of trying to buy distressed assets, which is the context that we're talking about it tonight. So I'm going to run these ads. There's 100 ways to skin this cat. If you want to do this yourself, you can send out mailers, right? You can put up signs. You can just tell everybody that you got cash and you're ready to roll. Deals will find you if you tell people you have cash. So our target market, obviously, are people who are behind on payments, right? If they're in that pre-foreclosure space, that's who are likely going to be typing "sell my home" for cash. People with properties that are dilapidated, they can't afford to fix them up. These people often want to, I don't want to list it, it's embarrassing, just how much to take it off my hands. Divorce, death, probate sales, those are big ones. Builders, this is a big one. You're going to see a lot of this now. You're going to see builders that are sitting on projects where they've got 10, 12, 15% interest on their construction loans. And it's going to get to the point where they're just going to say, take it, you can have it at my cost, or even less, right? They have equity, too, that they can spend to get it off their plate. So you're going to see that. You're also going to see people, that's how we bought that fourplex on Stockwell from a builder. And I think it was appraised at the time for 2.1. We got it for 1.7, which was his cost. We held it for 9 months, sold it for 2.6. Different market, but same concept. People who are getting transferred out of town, they just got to go. House isn't selling, they don't want to rent it. Okay, just take it, right? People who are in need of like instant liquidity to take advantage of some sort of opportunity, I would be this person in many cases. Like if I need a couple $100,000 to do something, like, okay, what can I sell? Yeah, I'll leave 10% or 15% on the table, just cash now, right? You just do it, people do it. It doesn't mean you're necessarily broke, it just means you need the money now. So those folks, you've also got people who have an offer on a house. People who have gone the wrong direction with the sequence of their events. They bought first and then figured their house would just sell. That's a no-no in this market, by the way. Anybody that you're talking to, people that you care about, tell them to sell first, buy second. It will cost them tens of thousands of dollars to do it the wrong way. All right, what else? So you've got investors that are also packaging and selling off multiple properties at a time. That's a good opportunity. Realtors, if you know realtors, when they're at the end of their listing contract, sometimes they'll take a Hail Mary offer. Guaranteed sale program of Vantage West Realty, that's what we do. So we've got a guaranteed sale program, and if we end up having to buy them, it's at a pretty decent margin of safety. So that's how we find some deal flow that way. So what is a margin of safety? Well, for us right now, I'm looking at the historic corrections that we've seen have been between 10 and 20%. We're at 18 now. So we were right kind of at the end of what would be a normal market correction. I don't think we're anywhere near done. So I expect that in the first and second quarter of next year, we're going to see another 10%. And then I think interest rates will come to the rescue and we'll find the trough. That's my guess. Again, anybody that tells you they know for sure is full of shit, but that's my best guess. The best deals are going to be on single family in that 1 to 1.5 range. That's what's getting hit the hardest right now. So that's where you're going to get your best discounts. If you can get to that price point, that's where you're going to see the best deals. So that's what I'm looking for our fund. We're looking to do this deal like we just did on Mount Royal over and over and over again. So what this looks like when we add our little secret sauce to it, which is the lease option program, it's the BRRRR strategy. You find $1 million home, you buy it for $850. Great. So you bought the distressed asset on sale. You spend $100,000, it's now worth 1.25. Cool. You could get off the bus there. That's a good profit. Or you could add the next little layer, which is the lease option deal on the other end. Now, the way a lease option deal typically works, if someone's a rent-to-own person and that's the only way they can get into properties, they expect to pay a premium based on the amount of time that they need. We use 3.5% per year because it's fair. It's below the 80-year average. It doesn't usually land them in hot water, and they're happy to accept it. It's kind of that fine little balance point. So if you take a 3-year deal on a home that's appraised at 1.25, and you sell it to someone 3 years into the future using that equation, you're going to sell it to them for 1.385. So you've really maximized this. You've got a rental property for that 3 years, and it's the best kind of rental property. It's the best kind of rental property to weather a downturn, and I'll tell you why. The tenant's going to give you 10%. So you've got even more of like a slack adjuster there that protects you. They've got skin in the game, so they're very unlikely to leave. You don't have any vacancy risks. They're not going to go anywhere. They've told their friends they bought a house. They're in it. They're going to ride out the storm. If the market doesn't recover in 3 years, guess what? They still want to live in their home. They're not going anywhere. Just extend the term. Okay? They're also sharing in the downside risk at this point because they have skin in the game. If the property goes down, it's their 100K or 10% that's at risk first. That's the first money that goes. Then it goes into your equity. So they're sharing in that risk. You've got a fixed price. That doesn't move. So the price that you've agreed to sell it to them is fixed. That's a predetermined profit margin. It's very hard to get a predetermined profit margin when you do anything speculative. This is a very cool way to know what you're going to make. The thing that can change is the timeline. What we don't know is how long the market will take to recover. It could take 5 years. It's possible. It could take 8 years. So that's the thing that can change, but what they're going to pay will not change. That's fixed. This is cool too. If, as a landlord, repair and maintenance costs will kill you, right? You can be positive cash flow, but then you got to do a furnace. Damn it. You're all good, and then there's a flood. Shit. I just spent $4,500 on new floors, right? You don't want to do the deductible because it's just going to raise your rates. So you're just coughing up this money, and it eats all your profit. In a rent-to-own situation, they've signed a contract that says that they understand that they will care for the home like a diligent owner would and incur all costs. It's essentially the true ownership experience, which is what they wanted to do in the first place. They just can't finance it. So you're not asking them to do anything they weren't trying to do, right? They wanted to be owners. So here's the ownership experience. The house is your responsibility. So that part's good. And then no property management. You don't have to visit the property, and you don't have to hire a manager. You can visit the property if you wish, but it's not needed because these folks have so much skin in the game that they're very unlikely to treat the home poorly. So here's a couple examples. We just did one that's going to mature. So this one's been a couple of years. They had a $130,000 deposit, bought a really nice house. They're going to be buying it off of us here in a couple of months for $1.485. We got happy rent-to-own buyers. We made a 24% margin on it. We now get to recoup this capital, redeploy it in a better market. Now, these guys were in the money for a bit. Like, they bought this 3 years ago, and then obviously everyone knows what happened with the market. This house was probably worth 1.8 at one point. It's now come down where they're still in the money a little bit, but they're not hitting the home run they were, but they're still happy to buy it at 1.48. Mount Royal was one we just flipped, right? So we bought this. This was appraised at the time at 1.2 and change. We bought it for $970. We spent $75K on the renovation, just a lipstick reno. We did floors, paint, baseboards, that kind of thing. We had it reappraised and got 100% of what we were asking at 1.25. Made a nice quick 30% ROI on that over 8 months. Quick in and out, and we now get to recoup and redeploy that capital. Fuller is a property we bought, a distressed sale. This was like a drug situation. There was like a whole bunch of sketchy people living here. This is that property I mentioned that had 12 rooms in it at the time. Really sketchy place. It was assessed at $1.5 million. We bought it for $1 million because it was that ugly. We went in there, we spent, I think, $100K or $150K on the property, made it all nice again, and now we've got students living in it, and it's like a cool little frat house. I kind of want to move in, actually. Anyway, it's a 10 cap. There's like, you can't find a 10 cap. You cannot find a property that will give you that kind of return. It's a little more management. Fortunately, I have a property manager that deals with it. I don't deal with it, but this thing is a home run. And as I was saying before, it's got a big lot, slightly bigger than the average. You've got an RU7 zoning, which allows you to build 4 units on it. And you've got 65 feet of frontage, so they could be nice big units. So I like this property. I'll keep it long term. So we bought that. That's just going to be in there, cash flow rock star for the next however long. We talked about duplexes. So this is one we're doing right now. We're currently in the process of renovating it. This is a duplex that probably, if you were going to sell it on the open market, was about $1 million. Similar situation, drug situation. You couldn't list it. It was really scabby inside. We went in there with a cash offer, got it for $830K. We're putting $100,000 in each side, okay? The strategy with this one is to simultaneously stratify it, right? So you submit to the city, you go jump through some hoops, and now you have 2 titles. The cheapest half duplex you will find on the market anywhere right now is like $700K. As I mentioned before, you can now legally put suites in the basement, which makes them affordable and more approachable for people at that low end of the market. So we're gonna renovate that, suite the basements, and sell each side for probably $700. I've conservatively said $625, but I still haven't seen a half duplex downtown with a suite for under $7. They don't exist. So really conservative profits on this. We'll be in and out within 8 months, $250K. We'll sell it in the first quarter of 2023. Vista Road, so this is a property where we assembled 2 side by side, 2 shitty little houses. We bought one and then we knocked on the door of the other, right? Pretty easy thing to do. One person's a distressed seller, you look at the neighbor's kind of dumpy too. Okay, well, knock, knock. Hey, you guys interested in selling? Yeah, lo and behold, they are. So we bought both. Bought them for 1.85, designed a 40-unit building on this. We'll just sell this now with a DP in place. That's a development permit, which means we've de-risked the project, and that'll now easily value that land at about 2.15, or just about 55 grand a unit is about what stuff sells for. So we'll quickly make a quick 25% on that and capture those gains. Similarly, bought this in distress last year in Turtle Mountain. It was listed for 1.2, we got it for 980. We designed a 50-unit building for it, de-risked this project simultaneously. It'll be a shovel-ready project soon, valued at 2.4 million. So all you're doing is you're taking something, a little diamond in the rough, adding value, de-risking it for a developer, and then you can either develop or you can sell and capture the gains. I've made a lot more money, I'll just say, buying property and making it someone else's project than I have actually building stuff out. Building stuff out is risky. You can definitely make a lot of money. I've broken even, I've lost money. I've never lost money doing a land assembly deal. And I take less cash and less risk. So if you're interested to talk more about that, we do have a management team. It's not just me by myself. I'm the general partner. We have Evan in the room here. He's one of our limited partners. He's got a ton of cash in it of his own, as well as some family money, and he handles all. I wanted an agent that had skin in the game. So he's the real estate agent for Cash Offer LP, and he's awesome at what he does, great investor. And we've got our legal beagle, and we've got Brad Levang, our in-house financial officer. So all of us are available if you want to chat. I'll leave you on this note. Before we go into a Q&A, I want to give you guys a chance to just fire questions at me, but the sentiment must be fearful when others are greedy, and greedy when others are fearful. Thank you. Not to be too pitchy, but if anybody does want to grab a meeting with me, the easiest way to do it would probably just be to grab a QR code, scan that goes right into my schedule. Then super easy, because I got to scoot out of here right after this, so I won't have a chance to chat too much after. So if they're interested in that, by all means, give you a second on that. And then, yeah, let's fire up some questions. Here, I'll fire it back for you if you're trying to take a pic. Any questions, guys?
I'm curious about the luxury market, like 3 million plus.
Yeah.
Do you have any?
Yeah, so luxury is the only sector right now that we're still seeing more sales. I haven't quite got my head around whether or not it's appreciating, but you're seeing definitely like 300% more sales over 3 million than we saw 2 years ago. Whereas everywhere else, we're like back to 90s numbers. Like 300 sales a month is what we were getting in 94, 95. But 3 million plus, we're in unprecedented territory still. So what does that tell me? That the 1% are not quite as affected by the interest rates as the 99.
Do you think the long-term horizon is really good? Like I've heard people saying they're scooping up legacy properties like waterfront because they're so limited.
Yeah, I mean, trophy property is always going to hold its value, like waterfront, stuff like that. The thing I worry about is with foreign buyers no longer able to purchase, who's buying the house in West Van for 12 million that's getting that person to come to Kelowna and buy for 5 or 6 and putting the money in their pocket? Like that was the play for so long. But that was offshore money coming and buying those houses in West Van particularly. So I don't know if that happens anymore. We'll see. Vancouver market's definitely slowed down considerably, and 20% of our sales and probably 50% of our luxury sales were Vancouver buyers. So will that happen? We'll see. Hasn't happened yet. Any other questions?
Wasn't that
Oh, cool.
Were you suggesting that was a dangerous market to play?
Mid-luxury.
Mid-luxury.
Mid-luxury is a scary spot because the people at 3 million plus usually are cash.
Right.
And so they're not really too phased by the interest rates. Up to like 2.5 even, most people are getting mortgages. And so imagine if you're carrying, imagine you had $500,000 and you go and you buy a house for $2.5 million and you've got a $2 million mortgage. And at the time when it was 2.3, you're like, yeah, I can float this. It's $7,000 a month. I can do this. I make $20,000 a month. Now it's not $7,000 a month, right? It's all of what you make. So that's a scary thing. So those guys are the ones getting hurt. Q&A. Any other questions you guys got? You.
Asking about short-term rentals. I know it's not in favor right now, but with the new regulations from the BC government, limiting regulations around age restrictions, is there any change to the number of days? So, like, can a building still say you can only rent for 30 days minimum?
Yeah.
Or is that going to change?
Yeah. No, they are not making it easier for short-term. Okay. For sure not. It does not apply. Which is good for the short-term rental market, to be fair, because if it was wide open, it would get really, really flooded, and hosts would see a huge decline in per night. What else? There was another question there. Yeah.
Yeah. In regard to the Airbnb rules, where the tenant doesn't have to leave if they don't want to. What if the tenant does agree, like, yeah, I have no problem being here for 4 or 5 months, and I'll gladly leave. Is that still an option?
Yeah.
They're both agreeing on it?
Yeah. It just means it can't be enforced. You just can't enforce it. But for sure, everybody's free to. The thing about tenancy law is you can't contract your way out of it. So you're free to ask people to do whatever you want.
They can't change their mind. Like once they're in there, they can't be like, well, come to think of it, I don't want to leave anymore.
Yes, that's the issue. They have unilateral decision-making power to stay or go. You can't. Your contract that you write is great. It sets expectations. It might work if they don't know, or if their situation doesn't change. But what's that?
That's funny. Sorry. It might work. Yeah.
It's just risky, right? And so if you're somebody that is going to get $2,500 a week for your place for the 12 weeks of summer, and you've got some student that wants to give you $1,700 a month for it for the 6 to 8 months of the off season, and you have to worry that he might not leave, you're still going to get some revenue if you just discount it on Booking.com and just stay in the short-term world, and then you're not subject to any of these rules, right? So that's probably the smarter play.
What's your take on infill, RU7, MN1 kind of properties in town?
Yeah, just the land costs had to come down. Like, you can't pay $1 million for them now and then go spend $350 a foot to build them and then sell them for $1.1 million anymore. That doesn't exist. Like, the really nice stuff, we just built one that, initially when we dreamed it up, we thought we were going to get $800 for it. Then when the market went parabolic, it looked like you could get $1 million. And lo and behold, we're back to $800. So the market's at $800 for those nice units. And, it's pretty hard to buy a piece of property for $800K, let's say even. So now you're $200,000 into each of the spots, and then you've got building costs that are going to run you $300 a foot or north of. You're going to spend another $450 or so to build it. Plus you've got all your soft costs, your selling costs, your carry costs. Like, it's really hard to make one of those projects pencil if you're not buying the land right. But definitely like those deals. That's a good segment of the market, like $800,000 townhomes downtown. That's a good thing to sell. People want that stuff if it's got 3 bedrooms. But how do you build it profitably? With if you can control the costs and you're a one-man band and you can do it, you can still make a margin.
What's the average construction cost per square?
Moving target, like low end right now, looking like pricing out this apartment building that I'm doing, which is like the lowest end that you can do. I'm still looking at $250 a foot, and with economies of scale, like being 40 units and such. A luxury property where 5 years ago you could build a luxury home for $350 a foot. Now it'll cost you $650. Right? Mid-luxury is going to cost you $500 a foot to build. What else?
Talking about stratas not being able to age restrict anymore.
Yep.
Is there fear of the actual strata councils in each of these buildings having some pushback, 55 plus?
So 55 plus is exempt. So 55 plus are still allowed to hold there because there's a bit of a seniors break there.
Okay.
Yeah, but the 19 plus, the no kids factor is the thing that they're able to enforce. So it won't matter. We've already tested this. Like, we've called the regulatory bodies and we've said, what if the stratas do this? They don't have the say. The Strata Council doesn't have say, but the 55 folks are safe. I got really excited for a second when I thought the 55 plus were going to be wide open because some of those places are cheap, like 200 grand for some of these places. I'm like, if that's rentable and no longer age restricted, that's a deal. But it didn't go that way. What else? Any ideas?
With Kelowna becoming one of the fastest growing cities in Canada, do you believe that the West Kootenays and the boundary country would be a great investment opportunity or an attractive opportunity since a lot of people might be moving to the country? Have you invested or bought any houses?
I haven't bought anything in the West Kootenays, but I've had a ton of clients from our brokerage that have gone that direction for their relative affordability. And anytime anything gets expensive, you see that the outlying areas, secondary markets do get better. I think they've got a lot going for it out there. I think that's a good investment for sure. There was someone else's hand.
What's the trend right now for joint venture?
The trend?
Yeah.
I think you're seeing a lot more syndicated stuff. Like you're seeing a lot more people getting involved in limited partnerships. You're seeing a lot. I'm not seeing as much where people are kind of going Dutch on a duplex anymore, where I used to deal with clients doing a lot of that. Now I'm seeing that there seems to be these more syndicated deals where there's 30, 40 investors getting involved in a project.
What
Or
about two people that just say, mail each.
Great, totally.
I like the idea of the duplex turning into a fourplex essentially.
Sure.
You own both sides. That's pretty cool.
Usually joint ventures happen because they have complementary, there's usually a lack so somebody's got time and expertise and somebody's got cash and no time and expertise, like the dentist and the realtor, right? Like that's kind of the.
Each brings something different to the table.
Yeah, that's usually how it goes. Like two guys with money typically don't need each other. You know what I mean? Like you can partner together, but it's like, okay, well, who's doing all the work, right? So there's usually there's a working partner involved. So it's typically like a yin and a yang kind of situation with a JV.
You spoke about the $1 million to $2 million properties and
Yeah.
you expect them to take the biggest hit. So in the first couple quarters of 2023, given the rate hikes, if they continue at the pace as well as into January, do you expect them to take more of a hike? And do you see that trigger rate for their mortgages are also going to play into the game here?
Yeah, and I think that's all going to play out in the first 2 quarters. But yeah, I think that is going to be the segment where the deals will be ripe.
I've already seen, I'm searching in that market, I've already seen where people have bought in the height in March and they're dumping the properties.
Yeah, because they just can't afford the payment. And they're trying to get off the ride before it gets really ugly. Totally. Good. Great questions, guys. Sure.
How much time do you think we have to get our hands on one of these new properties that are now allowed to be rentals before they kind of just get priced?
Yeah, I think that gets priced into the market within 2 months, would be my guess. The cat's out of the bag. It's not like some secret that only realtors know. Like people know about this now. It made the headlines. I think it's going to be quick. Yeah. Cool. Any other questions?
I live in Penticton, obviously. I see a lot of multifamily. It's pretty cool. Anywhere from old fourplex, eightplexes.
Yeah.
I know I kind of perked up when you said that, but you said they're all really held and hard to break into.
Yeah, like
They're inverted. It's just.
people own those things for 40, 50 years, right?
So they're good then.
And candidly, that's why I want to buy them. I want to buy them to pass them on to my kid, right? Like it's a multi-generational thing. That's what you do with apartment buildings. So they seldom come for sale.
They're tough to acquire.
When they come for sale is when you try to pass them to your kid and your kid's like, I don't want that thing. That's and that's happening. But that's the only time it comes. But like, and you see it's a lot of like, for some reason it's a lot of like Italians, Greeks, Portuguese people that they like acquired these things over the years, and they had this idea in their head that like they're going to build this huge legacy portfolio and give them to the kids. And I almost never see the kids want them, which blows me away because there's so much opportunity in that. But yeah.
That's good for the money.
Well, yeah, they still don't change hands very often, but they often don't even see the light of day. Like they don't even make the MLS because everybody knows somebody that wants your apartment building if you're ever going to sell it.
So if you want to acquire it for this program, it would have to come from other provinces, more likely.
Look, I'm not to say they never come up, but it's
Or
just
not never,
it's
but
seldom.
rarely.
Yeah, there's way more opportunity. Like I just checked in with my Calgary affiliate agent and my Edmonton affiliate agent today, and they both had like a list of 25 decent apartment buildings up to $5 million. I looked in Kelowna, there's none, 0. So it's a big difference. Awesome. Well, I wanted to get you guys out of here on time. I hope you guys got tons of value from it. It was really cool for me to get the reps in and get practice speaking to a big audience like that. And I hope I gave you a positive ROI on the time. Thanks so much for coming. Appreciate you.